Hi, everybody. Welcome to today's Lunch and Learn series class. I'm Steve Mahoney. I'm joined by Kathleen Thompson and Al Kowal. We're all mentors with the Greater Hartford chapter of SCORE. Today is the fourth in our series called Startup School for New Business Owners. And today's class is all about business financial management. In our first classes, which if you haven't seen, you can check out on our YouTube channel, we talked about new business owners, Sarah and Homer, and what they were trying to do in starting their two businesses. If you remember, Sarah is interested in creating a pet food business, and Homer is interested in creating a home companion business. So, as we went through each of their business journeys, we talked about all the different things that they did to get started. They answered the big questions for business owners, all the different aspects of running a business and figuring out if it was the right career move for them. They defined their product and service with clarity and picked their business name. They developed their differentiation strategy on how they're going to beat the competition. They developed their value proposition and they did market research to find their target customers. And they also developed a marketing and sales strategy. Now they need to figure out how to make money. And that's what we're going to talk about today. So this is a recap from the first class where we talked about the key aspects and big questions that a business owner needs to answer as they start a business. How are you going to make money? And one of the things we talked about was doing the math. So trying to figure out how much revenue you can make is simply the price you're going to charge times the number of units. And that could be a product or it could be a service. Determining your profit is your revenue minus your expenses. Now, there are different revenue models you can do. You can, in the service business especially, you may want to charge per hour or per day or per engagement. If you're pricing a product, it could be the number of products you're going to sell. You could also consider volume discounts as you're pricing your product. Some businesses have subscription models where if you subscribe to a business for every month, you can kind of get as much service as you want or need. Sometimes you could have a business where you earn a percentage of revenue or a percentage of something as your revenue, like a commission. How do you find the right price? That's tricky. We're going to talk a little bit about that today. And I know that's of interest to everybody on this call. So, pricing your product or service, there are a lot of factors to consider. There's no simple answer as to what the right price is because there are so many factors to consider. Probably first and foremost, it's consider what the competition is doing for a similar product or service. They may not have the exact same thing that you do, but consider if it's similar enough. You're trying to sway a customer to come to you versus the competition. Now, you may also be willing to charge a little bit higher if your value proposition offers something of better quality or something that differentiates more than the competition. Customers may be willing to pay more for that. Or you may be in a business where you want to be the cheapest thing out there and try to win in terms of volume. So maybe you want to price your product a little bit lower. If you're in the service business, you're probably looking at an hourly rate. So considering how long it takes you to complete a project or to complete the service. It could be a hairdresser, it could be a massage therapist, or you could be a consultant doing an engagement for several weeks and thinking through how many hours it's going to take you to do that project. Now, there's other options where you're pricing a project where you may want to do something like a cost plus model, which basically means my product costs me X amount to make or purchase, and I'm going to resell it for Y. And then you could think about a target profit margin on a dollar per unit or your percentage of sales. So there's a lot of different things you can think about in terms of methods of pricing. Now, there's no real right price for any product or service. I describe it as it's kind of the sweet spot wherever a buyer and seller are willing to kind of meet in the middle. There's a thing called pricing elasticity, and think about it like a rubber band. If the business owner prices their product too high, the band is going to snap and the customer is going to walk away and go to somebody else. If the business owner prices the product too low, they could get an avalanche of customers coming in to buy their product or service, and that could impact not only your profitability, but could also impact your ability to meet demand and provide good quality of service. So thinking about a rubber band that gets pulled at the right tension is that buyer and seller pulling on each other. The best advice I can give you is do research about the competition in terms of similar products or services or what other people are doing, and then try a little experimentation. Try a little trial and error in trying to figure out why customers are coming to you and why they may be walking away from you. and adapt accordingly. Another component of pricing your product or service is understanding your cost structure. Now, there's a big difference in your cost structure between fixed costs and variable costs, which we're going to talk about next. So, understanding your cost structure. If you're a retail business or a product business, you have what's called cost of goods sold. This is the cost to acquire or produce your product. This is generally not relevant for service businesses. So in Sarah's business, like the pet food business, that's going to be a big part of her pricing analysis is going to be the cost of goods sold. For Homer, however, he doesn't have a real product he's selling because he's selling his time and expertise. Now, there's different costs in a business. There's variable costs and fixed costs. Variable are ones that change with revenue volume. If you pay someone to sell your product or service for you and pay them a commission and they get paid on a percentage of sales, that's a variable cost. Some of your payroll may be variable. I have a client that I work with in SCORE who runs a painting business. Sometimes when he gets so much business, he needs to hire another crew and hire more painters. The more they work for him, the more revenue he earns. That's an example of a variable cost. So some payroll could be variable. On fixed costs, there are some kind of obvious ones that people generally think of, often called overhead. And these are costs that don't change with revenue volume. They may change year to year, like your insurance costs may go up, your rent costs may go up. So they may increase or decrease year to year, but they don't change with revenue volume. So variable means is it tied to revenue volume, not does it stay fixed forever. So examples would be like insurance, rent, accounting, attorney fees, things like that. Those are costs that are going to be there whether you sell one product or a million products. Payroll and marketing are ones that could be fixed or variable. So you could have a marketing or marketing promotion that you do every single month that might be fixed, but you could also have a big campaign if you're going to try to drive a new product or service. Then that might be an example of a variable cost where you're really trying to drive more revenue. Payroll is another example. So use my painter as an example. I talked about how his crew that he hires, if they're going to be doing more jobs and bringing in more revenue, that would be variable costs. But if he has an office assistant who works 40 hours a week, who does a lot of his billing and administrative work, that would be a fixed cost because regardless of how many customers he has, he's always got that cost there. So understanding your cost structure, an important part of this financial management. So now we're going to do some math for Sarah's business. We're going to talk about both Sarah and Homer's business as we think through pricing and kind of what we call the break-even analysis. So Sarah's in her startup mode. She's decided she's going to estimate what her costs are going to be. And we've made all these numbers up, much like we made up these two businesses. So what I've created over here is just some analysis for Sarah to say, all right, how much does it cost me in terms of my per unit cost for cost of goods sold? And she's figured out that it costs her $21.75 for her ingredients, and it's going to cost her $3.50 for her packaging and mailing for a total of $25.25. Every unit is going to cost her that to make and ship and sell. And then she's done an estimate of how much her fixed costs are going to be. They're not going to be a lot to start. She's going to put aside a lot of money for marketing and advertising, and then a few other things here for some of her fixed costs. So she's in startup mode, kind of doing this herself, but there are some things that she might want to consider in the future. So for example, if she gets so big and she needs to like get some space, she may have rent expense, maybe additional insurance, maybe some utility costs. Maybe she decides she wants to actually get her product into some local stores to sell it, and she might pay them a commission for every unit that they sell. That would be an example of a variable cost per unit that she would have to add into her analysis for her cost of goods sold. She also may need to hire additional help at some point with increased volume. That'd be an example of another additional staff person, another cost. So this kind of analysis can change over your time as your business is growing, but here's where Sarah is to start. So next, what we're going to do is what's called a break-even analysis, because Sarah's got to say, all right, if it's going to cost me $25 per unit for me to make, how much do I have to make to just break even? So this is a little spreadsheet I created, and you're going to get this template that you can use afterwards. You could play around with this for your own business if you find it helpful. And there's two different ways you can look at break-even analysis for like a product business like this. So the first is if you start with this analysis down at the bottom, and I've created a first scenario where she's going to price her product at $39.99, and she said maybe that's a sweet spot for me. We know what our cost per unit is, $25.25. So gross profit, meaning for every unit she sells, she's going to make $14.74. We know her fixed costs are $4,000. So she's got to sell enough units to cover those fixed costs to pass what's called her break-even point. So if you divide her fixed cost divided by the gross profit per unit, that says that she would need about 271 units to sell just to cover her fixed costs. Every unit she sells above that, she's making a profit. There's another way you can see that, which is this little sensitivity table up here, which has the sales revenue, the cost of goods sold, the fixed costs, and the profit, depending on different scenarios, depending upon the number of units she sold. So I'll show you how this works. So in the first column, if she sells 0 units, she has no revenue, no cost of goods sold, and she still has her fixed costs, so she loses $4,000. Remember, those fixed costs never go away, regardless of how many units you sell. She sells 50 units, she's got $2,000 of revenue, she's got a $1,263 of cost of goods sold, $4,000 of fixed costs, and her net profit is a net loss of $3,000. As each of these scenarios go up by 50 units per increment, you can see that the revenue goes up. You can see the cost of goods sold go up because every time you sell another unit, each of those items increases. But the fixed costs always stay the same. So if you notice down here, it says her break-even point is 271 units. And if you look here and you go along these different scenarios here and you see that between 250 and 300 units, she flips from a loss to profit. That means she's cleared that 271 units. This is just a way for you to kind of do some analysis to say, I've got a good business idea. I know what my cost structure is. Could this be financially viable for me? What would I have to believe to break even and cover my minimum cost structure? And then we can start doing some other scenarios. Now, if she decides what would happen, what would this look like if I changed my sale price from $39.99 to $49.99, you can see that down here, my gross profit has gone up $10 per unit. And now my break-even units is down to 162. So now you can see she's crossing that threshold a lot quicker because her unit price has gone up in terms of what she's selling it for. So there's a lot of different things you can play around with as you're thinking through these pricing scenarios. You could think about how much you're going to charge, but you have to consider that pricing elasticity. Is a client going to be willing to pay for what you're selling? And in Sarah's case, she might. Her customers may value what she is doing for the health of their pets to be willing to pay that higher price point. She could also look at what else is out there for competition. Another way to improve this gross profit per unit is to try to get a better cost of goods sold per unit. Maybe she can find a way to lower her ingredients costs. So there's 2 different ways you can improve that gross profit. One is to increase your sales price, which could have a pressure point with the customer's desire to pay it. The second, which is more impactful, is how do you get a lower cost per unit to improve your profitability? So after she does that, she's going to do what's called a cash flow budget. And you're going to get a copy of this template as well. Now, what this looks like, the way that we've created this is an example of all of the things you want to put through into a cash flow budget. I'll walk you through the columns here or what the rows are, and then I'll share with you what Sarah's budget may look like. So it's basically kind of a roll forward of your cash balance. You're going to start with your cash at the beginning of the month. You're going to put in your estimated sales. You're going to put in your ingredients, your cost of goods sold. She's going to put in her different fixed costs. And then she's going to put in her packaging and shipping costs. And then she's going to come down what's called her net change in cash. Now, this is really the operating cash flow of a business. There's other aspects of cash flow I'm going to talk about in a minute. But this is really operating cash flow, very similar to what you would see on your income statement. And the last row is going to be what her cash is at the end of the month. Now, I highly recommend people do this, especially as they're starting out, to do this by month and to try to do this for at least the first 2 years, just so you can see how a business may grow and where your cash pressure points might be, depending upon how the business is going to grow and what you have to spend money on. So for Sarah's business, we've created a 12-month cash flow, and I want to walk you through a few key assumptions here. So you can see her cash at the beginning of the month. She's estimated what her sales are going to be. So she's estimating she's going to start out in March and she's going to slowly grow to, kind of get up to the $4,000 range by the end of the year in the last month of the year. Then she's got her ingredients and cost of goods sold. Now, if you'll notice, she's got some ingredients and cost of goods sold here before she has any sales. That's because she's got to get the food kits prepared. She's got to do some prep work, some startup work before she actually starts selling to her customers. This is kind of that startup cost mode that you have to think about depending upon how your business is gonna ramp up. She's put in what her marketing and advertising costs are going to be. She's got some one-time payments for insurance, accounting, and for attorney. And then she's got her shipping costs that are going to be down here. So when you add all this stuff up, what this basically tells us is that in the first month of the year, she's bought some ingredients and she's put some marketing in place, but her net cash is going to be negative $1,000 because she hasn't sold anything yet. The way this template works is at the end of the month, your balance carries forward to the top of the second month so that she buys some more things and she's now going to be kind of negative 2,500. In reality, she would probably be funding this with her own money, but this just gives you a sense of the negative cash flow that happens at the beginning of a business. So then once she starts selling, she starts bringing in some revenue, and that helps offset her ongoing monthly costs a little bit, but her cash is still down 150 the next month. The following month, she's got some early on expenses. She's still a little negative. By the month of May, she's actually turning cash flow positive. Her sales have now exceeded her expenses, and she's made positive cash flow for the month of May. And you can see as we go along each month of the year, that single month cash flow gets better. However, her cash at the end of each month is still negative. So even though she's turned positive in the individual month, she's still got that deficit that she's carrying forward until she gets to November. This is basically because she's got to have a lot of startup costs up front before she can really ramp up her revenue. So this depicts why we recommend you do a 12-month cash flow projection to start, because it really helps you time out when you're going to turn cash flow positive in the month, in Sarah's example, May, and when are you going to pass the hurdle for that deficit that you've built up to start the business. So here, she doesn't turn that until here November. So if I were advising Sarah and I saw this, we'd go through the assumptions and say, okay, this looks good. I would say this tells me that you need at least probably $4,000 to $5,000, maybe $6,000 up front to put into the business to help cover these deficits before you turn cash flow positive. And I'd want a little bit more than this kind of negative 3,500 or negative 3,900 because you'd want to have some cushion in your bank account. So I might say at least $6,000 to $10,000. So this is an operating cash flow for kind of a product business. So we talked about Sarah's, kind of thinking about her pricing strategy, which for a product business and a retail business is a little more complicated. For a service business like Homer's, it's a little simpler. You don't have cost of goods sold. You can still do a break-even analysis, but it's really determined by your hourly rate, if that's how you're charging your business, which in this case, I've assumed Homer is doing. So let me walk you through what we've created for Homer. So when you're thinking about a service business, much like Sarah thinking about how many food kits she's going to sell, with Homer, his unit is going to be client sessions. That's how we're going to think about it. So if he says, all right, how many client sessions do I want in a week? Let's say my target is 15. And if I multiply that by 50 weeks in a year, for round numbers, that's about 750 weeks in a year. That's 750 sessions in the year, I mean. And let's say I've determined I'm going to charge $60 per session. If I take 750 times 60, that means I'm going to bring in revenue of $45,000. And he's gone through and calculated his expenses. He's going to rent some office space. He's got to create some educational materials or buy them. He's got some insurance, and maybe he's going to hire someone to do some accounting and billing work for him. And he's got $26,000 of expenses. And you can see if you take his revenue minus expenses, his net profit is $19,000. Now, he could ask himself, like, if I want to ask if this is a viable business, like how many sessions do I need to do just to cover my costs and break even? It's a similar calculation as what we did for Sarah. But with Homer, it's basically the number of sessions he's going to have in a year. So if he's got 26,000 of expenses to cover and he's charging $60 per session, if you take 26 divided by 60, he needs 433 sessions over the course of a year. If I divide that by 12, that's 36 per month. You could say that's about 9 a week. He could ask himself, all right, just to cover my expenses, I've got to have at least 9 to 10 sessions a week. All right, maybe I think that's reasonable, but I don't really like this $19,000 number. How could I make that better? Because I want to make more over the course of a year. Maybe I could charge more. Maybe I'm going to increase. I'm still going to assume 15 sessions per week, but I'm going to increase my price to $85. My revenue goes up. My expenses are still the same. My profit goes up. Now you'll notice my break-even point has gone down because now I'm charging more per session, much like when Sarah increased the cost of her kit or the price of her kit, the number of her units she needed to sell went down. Same thing with Homer. He increased his price. The number of sessions he needs is now only 25 per month instead of 36 per month just to break even. He says, okay, this is a little bit better, but I still want to try to make a little bit more. Maybe I could try to do 25 sessions per week and charge $70 an hour because maybe $70 a session is more reasonable. Maybe 85 might be too much. And now I've kind of looked at this and said, all right, revenue's 87.5, my expenses are 26, my net profit's going to be 61. Here's my break-even calculation. Okay, I like this. But he's got to ask some key questions as he's thinking about if this financial model will be right for him. You're not going to be able to predict everything, but there are some key things to ask. Is this rate in line with the competition? Now, Homer's business may be unique in terms of what he is exactly selling. People may not be doing these kinds of services specifically, but he has to ask what other services might these people be buying and how else are you competing with them? Is $70 too much? Is $70 the sweet spot? Is 85 too much? So he's got to start to think through if he's going to be able to demonstrate the value for his service in setting his price point. Are the customers going to be willing to pay that? The other thing you have to ask yourself is you could do spreadsheet math all day long and make this number as big as possible, but can he actually physically service 25 sessions per week for all of his clients? That might be too many. If he thinks about going to people's homes and traveling and any pre-work or follow-up work, is that realistic? He may decide that if once he builds his business up, that he's got so much volume and opportunity that he needs to hire somebody to bring in to service more clients. That changes his cost structure because he's got to pay that person. So that would be kind of step B of doing an analysis like this, maybe after Homer has proved the value proposition for his business. So similar concepts in terms of product and service and thinking about how are you going to price it? How much, if you're doing the math, price times number of units equals your revenue, revenue minus expenses equals profit, doing a break-even calculation to say, what would you have to believe for me to cover my costs in the first year and prove that this is a viable business? This high-level math is a step that we take with a lot of clients to say, your business idea is great. Let's figure out if it's financially viable for you because there's only 24 hours a day and you're competing with a lot of different other companies. Now, Sarah did her cash flow budget. Homer could do the exact same kind of budget, right, for his estimates and figure out when he's going to have to pay these things and what his cash flow would look like. But some other things to consider when you're doing a cash flow. In that example I shared with Sarah, that's what we call operating cash flow. Very similar to what you'd call your profit on your income statement, revenue minus expenses. Is your business making money month to month in the core of what you do? There are two other major components of a cash flow statement, which I'm going to share in a few minutes. The first are what are called investing activities. So these would be additional capabilities or equipments that you're going to buy for your business. So think like a landscaping business has to buy trucks and mowers. That would be a perfect example. You're making a one-time investment to maybe you finance it or maybe you pay with it with cash, but that's an investing activity, an investing use of cash. The third component of cash flow is called financing activities. There's two aspects of this. One is any business you're going to do with a bank. If you borrow money from a bank, that's a financing activity. If you pay it back, same thing. It's just cash in or cash out. The other aspect is when you put money into your business, that's called an owner's contribution. And when you take money out of your business to pay yourself, that's called an owner's draw. Those are also called financing activities. A key thing, these types of activities generally do not show up on your income statement, which is why it's very important to look at your cash flow statement, which we're going to do in a minute. As you're thinking about budgeting and doing your cash flow budget, a few words of advice. Use the past results to help project the future. If you have some history with your business, see what you've done in the past, see if there's seasonality with your business of when your revenue increases or decreases, making sure that you put your quarterly tax payments in the right month. You pay your insurance once a year, put that in the right month. That's a good reason to do a monthly cash flow budget and not just once a year so that you can avoid surprises. So use the past to help project the future, but take into account new facts and trends. Are your prices changing? Are your costs changing? Is inflation pinching your cost structure a little bit? So use the past, but also think about the future trends. And then that spreadsheet that I'm going to send you that I shared earlier has got a lot of rows and columns in it. It might seem overwhelming once you start putting numbers into it. It might seem overwhelming, but use the 80-20 rule. Focus on what's going to move the needle for your business. First and foremost, it's your revenue model. That analysis we thought through with Sarah's cost structure and Homer's different pricing scenarios. Spend a lot of time on revenue, spend a lot of time on your variable costs. Make sure that the variable cost assumptions you have, like your cost of goods sold, if that's applicable, are consistent with your revenue assumptions. You want to make sure those are in line with each other. And don't worry about the small stuff. Like make a high level estimate for your internet costs or your insurance costs. But what's going to really move the needle are the things you want to spend the most time on in doing a cash flow budget. The other piece of advice I'll give you is that remember that it's an estimate. You're trying to figure out a range of outcomes. Don't be overly aggressive. Don't be overly conservative. When you start this exercise, your range of outcomes is a mile wide. You're trying to find some guardrails in terms of what you'd have to believe for that financial outcome. And a SCORE mentor can actually help you a lot with this. So, other pieces of advice in managing your financials: keep your books updated. Ideally, you'd be using an accounting software. A lot of our clients use QuickBooks, where we don't get paid to advertise for QuickBooks, but we know it's a reliable tool for people. There are other tools out there that you could use as well. If you're just starting out and you don't want to pay for a subscription to QuickBooks or another software yet, at least track of what you're doing in Excel. Just keep track of your revenue and expenses so you can A, help inform your taxes, and B, more importantly, know what's going on with your business. Review your bank and credit card activity regularly. Can't emphasize this enough. Look for any unusual patterns or any, God forbid, any fraud. Review your financial statements periodically, at least monthly. And we're going to go through some examples of those in a minute. And then when you're looking at the financials, I'm going to give you some key questions to ask yourself as you're looking at them so you don't just stare at them and think, what do I do with this? The goal of the financials is to really use those past results to inform future business decisions. What are you seeing and how should you react to it, if at all? So let's start with the cash flow. You may sometimes hear the phrase that cash is king, and that refers to the fact that the cash flow statement is probably the most informative financial statement of any of the three major ones because it tells you pretty much everything you need to know about a business. So I've got an example here that I'll walk through in a minute, but the three sections, as I just mentioned, are operating cash flow, which is akin to P&L profitability or income statement profitability. Basically, how much is your revenue or how much is your business earning in its core operations? Investing, what did you invest in with your operating cash flow? Financing, did you borrow money? Did you pay it down debt? Did you pay yourself? And as I mentioned earlier, investing and financing activities don't always show up on the income statement. So I'll just walk you through this example quickly. The first section you can see is operating activities. It starts with the net income. And then this is a standard report that'll come out of your financial software if you have one. What it'll do is it'll adjust for any non-cash items that didn't show up in your income statement. So for instance, you'll notice this business has lower operating cash flow than net income. And a big reason of that is that they had some big increase in accounts receivable. So they've earned the revenue, but they haven't collected the cash yet. So that's a nice thing to know, is that you've got more cash coming. So in terms of investing activities, you can see this business spent $48,000 in capital expenditures, but they also sold a vehicle. So they used $15,000 of their operating cash flow with investing activities. I would say for most businesses starting out, investing activities don't pop up a lot unless you're buying a lot of fixed assets or investing in like buying a building. If you're leasing a building, it's not going to show up there. It's really about buying things, not renting things. Financing activities are popular for just about every business. You can see in this business, they've paid a dividend to the owners, or this would be an owner's draw, an example of that. of 13,000. They borrowed $150,000 from a bank. That's why the cash is going up. Then they paid down a portion of their debt, which is that $52,000. So they got about $85,000 of cash from their financing activities. So if you can see, their net cash went up $297,000, and you can see what the sources were. They generated 227 in operating activities, they used 15,000 in investing, and they brought in $85,000 in financing. So this is key because a lot of these things here don't show up on your income statement. You're not going to see a $150,000 loan proceed show up on your income statement because that's just not how the accounting works. So let's talk about the income statement. This is where you assess your profitability. And these are the key questions that you're going to want to ask yourself. So I've done an example here for a product or retail company because you can see it's got cost of goods sold. So you've got revenue, cost of goods sold, and the difference is gross profit, just like we saw with Sarah's business. The key question to ask yourself is you look at your revenue year over year, is it growing or shrinking? Are you growing the top line, and do you understand why? It could be you're selling more to more clients, more product, more service, or you maybe put some price increases in. In looking at your gross profit, is your product priced correctly? Gross profit dollars are interesting, but you also want to look at your gross profit percentage because as your revenue grows, your cost of goods sold is going to grow. But if your gross profit percentage is going down, that could indicate that even though the dollars might be going up, you're actually going to be reducing your overall profitability because maybe you've got a cost structure problem or maybe you've got some pricing pressure. If you were to look at this income statement for a service business, they're not going to have the cost of goods sold line more than likely. They're just going to have revenue and their expenses. And as you look at your expenses, understanding what we talked about earlier about fixed versus variable, do you understand the difference? Are you controlling your fixed expenses as fast or as tightly as possible? Are you maintaining them as close to flat year over year? It's hard to do sometimes with inflation, but that can be a figuring out a way to how to become more efficient in how you spend money. Variable expenses can grow with revenue, that's okay, but you want to make sure that they're not growing faster than your revenue. If your expenses grow faster than your revenue, that means your profitability is going to shrink. The last thing you could look at is how you're performing versus budget. Again, if you did a revenue or a P&L budget or a cash flow budget at the beginning of the year, you could compare it to it as you go through month to month to say, how am I doing? And do I understand why some of these line items are higher or lower than each other? So just to round out the income statement, you've got your gross profit, you've got all the expenses here. The difference between the two is called operating income. That's kind of your profit before taxes and interest. This business has debt, so they've got interest expense, they've got their income taxes, and then net income is your bottom line. Net income on the P&L is pretty similar to what's going to show up. It's going to be the exact same number that shows up in your cash flow statement as the starting point. But again, if you've got some non-cash items, it won't be the exact same number as your operating cash flow. The last financial statement is your balance sheet. Now, this is different than the previous two examples. The cash flow and the income statement tell the story over a period of time. So when you run those reports out of QuickBooks or your other software, you're going to say, what was my cash flow for the 3 months ended March 31st, which covers January 1st through March 31st, covers the activity for just those 3 months. Same thing with an income statement. You might look at an income statement for 12 months ended December 31st. You never look at a cash flow or an income statement over fiscal years. You would never say, what was my cash flow from July 1st, 2025 through, March 31st, 2026. Businesses usually look at it within the calendar year. A balance sheet is a different financial statement in that it's not over a few months or a year, it's as of a point in time. Think of it like taking a picture of your business as of today or as of month end. And it says, as of today, what are my assets? What are my liabilities? And what is my equity? Assets are the things that your business owns. You can see them all listed here. They are usually listed in order of liquidity. What I mean by that is how quickly can you turn these assets into cash? Cash is always listed first because it's the most liquid asset on your balance sheet. Accounts receivable always comes next because you've already sold something and you're going to turn that into cash next. Inventory is next because you've got that inventory in-house and you're going to sell it turn it into accounts receivable, and then turn it into cash. The next few items, as you can see, are kind of go in declining order of liquidity. And so if you look at property and equipment down near the bottom, you've bought a building or you've bought land. That's a long asset that you're going to take a long time to recover. You're not going to turn around and sell that a few months later. Liabilities are what you owe other people. Accounts payable are for things like that you've purchased but haven't paid a vendor yet. Notes payable is money you borrowed from a bank and you haven't paid back yet. Equity. Equity is what's called your net book value in your business. There are three things that cause equity to change. When you put money into your business, your equity goes up. When you take money out of your business, like an owner's draw, your equity goes down. And the third component is your net profit on your P&L. When you have a net profit, your equity goes up via this line called retained earnings. When you lose money on your P&L, your retained earnings and your equity go down. So that's the three ways your equity goes up or down. Put money in, take money out, or the net profit of your business that shows up in your P&L. All of these financial statements are intertwined with each other. So as you record an entry in your income statement, it immediately impacts your balance sheet. You can test this out by booking an entry into QuickBooks and then run the income statement and run the balance sheet, and you can see how they've come through each of the different statements. The other aspect to consider about a balance sheet is that you'll notice that the total assets equals the sum of total liabilities and equity. So this business has 472,100 of assets, liabilities of 247, and when I add in the equity, it also equals 472,100. So some key questions to ask yourself when you're looking at your balance sheet. Look at your cash balance. Is it sufficient? Do you have sufficient liquidity for the next year? Are you worried about having enough cash to be able to make your next few months of bills? Current assets versus current liabilities. This is usually more applicable for a larger organization, but this answers the question of, are you over leveraged? If you have a lot of debt in your liabilities and you've got a lot of money that you've got to pay back to your bank very quickly, and you don't have a lot of current assets of either cash or receivables or things you can quickly turn into cash, you might be over leveraged and have a hard time making your debt payments. This business looks okay because they've got current assets of $149,000 and current liabilities, which represent really money that's going to be owed over the next 12 months, of only $47,000. So they're in a pretty good shape. Their debt is more long-term, so they have longer to pay it out. Asking if your assets are high quality. What do I mean by that? You've got accounts receivable on the books from customers who haven't paid you yet. Are you sure they're going to pay you? Are they reputable businesses? Do they have a history of defaulting on any of their receivables? Or are you confident they're going to pay you back? Is your inventory good or has it gone stale? Or is it not really resonating with customers anymore? Are you really going to be able to sell that inventory and turn it into cash? And then the last thing to ask yourself is your equity positive or negative? If it's positive, that means that you've made enough money that your retained earnings is growing and you've put more money in than you've taken out. If that equity has gone negative, that means that you've taken a lot of money out of the business and maybe you're losing money and you're going to probably struggle to continue. So these are the key questions to ask yourself. Let's talk a little bit about tax planning. I'll emphasize that this is not official tax advice. Highly recommend you consult with an accountant and a CPA as you think about preparing your taxes, but just some general guidance. You're going to want to make sure, especially if you're an LLC or a sole proprietorship, if this is a big piece of your income, if you're doing this as the majority of your income and you don't have a full-time job or another income source, you want to make sure you're making quarterly estimated tax payments. When you file your taxes every year with the government, they're going to expect that you've paid a portion of your taxes the previous 12 months. If you're employed at a company, your withholding that your employer does, they take care of that for you. They send that money to the IRS. They send that money to your state for your state income taxes. But if you're self-employed, it's your responsibility to make estimated tax payments. If you don't, when you file your taxes, for instance, this time of year, if you haven't made any estimated payments for all of 2024 and you're doing your taxes, you're going to probably have some penalties and some interest to pay when you do your taxes. Obviously, you have your annual tax filings. Your accountant can help you with that. Recommend you meet with your accountant in advance to plan accordingly. Maybe meet with them a few times a year so they understand what's going on with your business. Any advice that they have. They can also help you with tax planning strategies for the future, not just doing your return. Highly recommend you keep your records organized on a monthly basis. That will make your annual tax process and your quarterly tax process very easy. Other income or other taxes besides income taxes, payroll or self-employment taxes, discuss this with your accountant. If you have a payroll service provider, if you've got employees, they will help you with a lot of this. Sales taxes, we get this question a lot. The state of Connecticut has a really good website for this. It's the Department of Revenue Services. It's business.ct.gov. It's a small business website. You can find a lot of your questions answered there. There's a whole section on sales taxes. You can determine if you are required to collect and file and pay. And if you need to do that, just make sure you plan accordingly and after you understand the frequency of that. So highly recommend you check out that website. And if you can't get the answer, you can contact them and they can help you with that. And just lastly, most importantly, tax planning is not just an annual exercise. It's something you have to keep an eye on as you're going through quarter to quarter and meeting with your accountant. Other resources to help you. We haven't talked about business insurance, but every business that starts up, we recommend you work with an insurance agent to look for what's called a business owner's policy. This will help you with things like general liability. You also may need tailored specific insurance for if you've got a product that you need to sell. If you've got a physical location, you might need some other like slip and fall insurance. If you're doing a lot of activity through your website, you might want to look at cyber coverage is another one to consider. But an insurance agent can help you with this. An insurance agent doesn't cost you any money. They will meet with you, they will understand what your business is and recommend some coverages. And then they will go out to the different carriers, the Travelers, the Hartford, whoever, and they will help shop some rates for you. So meet with an insurance agent because they can really help determine what the right policy is for you and understand what your risks are. Also, a good exercise to do, and this may not be super important up front, depending upon your business, but it might be as you go farther along, is to do a risk assessment for your business. We've actually taught a couple classes on this. You can find some sources on that one. We'll give you a link to doing a SWOT analysis, which is doing strengths, weaknesses, opportunities, and threats for your business. I found a good website out there that's got some good advice on that. Recommend monitoring your credit reports if you're not already doing this. You can go to annualcreditreport.com. This is mostly for your personal credit, but it's really important because that can influence your business credit as well. Stay connected with your bank. Have a relationship with your banker. They can help you not just when you need a loan, but if you run into any trouble, having that relationship can be important so they can help you navigate any difficult periods that you're going through with your business. You'll get a copy of the cash flow budgeting template. We're also going to share with you that break-even workbook that I did, so you can play around with that as best you can. If you run into any issues with these and want to work with a SCORE mentor on that, obviously sign up to get a mentor, and that's something they can help you with. Don't feel like you got to do this alone. And then lastly, we've got a number of webinars on financial topics that you can find on our YouTube channel. If you go to YouTube and search for SCORE Greater Hartford, you'll find a lot of our webinars on there, and we've got them organized into different playlists. So you can check that out. So with that, that is the end of my prepared presentation, and we can open it up for Q&A.
Great. Yeah. So if anyone has any questions, please add them into the Q&A, and we'll get through them as they come in. So Steve, we do have a few questions already for you. So I think the first two sort of go together, but the first part of the question Mary asks is, how do client sessions compare with number of clients? And this was related to when you were going over Homer's financials and sort of like his break even. And then the second part of that is, in addition to his sessions, Homer will have other draws on his time, like promoting his business, prep work, etc. How do you factor those types of things in?
Yeah, great questions. So I purposely used number of sessions instead of number of clients because as I was doing that, I was thinking that you may see certain clients 2 or 3 times a week. So I was thinking like if I just did number of clients, that might not be as clear. So I did it in terms of number of sessions because you could have a client that you see once a week, you could have a client you see 3 times a week. So that would add up to 4 sessions. And if you charge for every session, you'd want to do it based on 4, not just kind of 2 different clients. So that was my logic behind that. But it's kind of the same logic. Which number of units are you selling of your time in terms of a client meeting? Now, you raise a really good point, Mary, about kind of promoting your business and running your business and your personal life and all those things. And where I was saying the example where he said, "Oh, I'm just going to do 25 a week," that's where you got to ask yourself, is that like realistically possible? And sometimes with a product business, we'll say like, all right, well, you're going to sell that number of units per week. Well, can you make that many? Are there enough hours in the day? It's the same thing with a service business. Do you have enough time to meet with 25 clients in a week? Can you fit them all in your schedule? Do you have to drive in between their houses? Like, is that even logistically possible? In addition to be able to actually having a personal life and doing the other aspects of running your business. So yes, absolutely right to think about like how many hours in a day there are, and how many days in a week there are.
Right. The next question is from Monica, and so she asks if SCORE has a list of good insurance brokers, and if not, how do you sort of identify those?
So we don't have a group of agencies that we generally refer to our clients, but what we've gotten this question a number of times in a few kind of specific insurance webinars we've taught. Best advice we can give is to search for independent insurance agents in your area. They're all over the place. You can look for these on Google. Look for what types of services they offer. They generally are very similar in that they'll help you with kind of your insurance policy. If you're already working with an agent for your personal insurance, you can see if they do insurance for small businesses. As you're researching the insurance agencies, you'll want to make sure that they actually work with business owners and small business owners. And you could look at their Google reviews and see if other people have left feedback. I'd recommend meeting with a couple just to get their feedback. And again, they're going to help you. They're going to ask you a series of questions about your business, and they'll help figure out and explain to you a recommended coverage and what the different pros and cons of the coverage are. Obviously, the more coverage you buy, the more expensive it's going to be, but they might help you understand the risk of, that, claim happening to you and whether it's worth buying the insurance. Some of the insurance coverages might be a little cheaper than kind of the bang for the buck that you get. So it might be worth getting that cyber coverage because it's not as expensive and it covers a wider range of things, a wide variety of things, as an example. So I'd recommend looking at that. And again, these insurance agents, they kind of run their own thing and they work with business owners, and then they are your conduit to the insurance carriers. The carriers are the ones who write the policy. They're the Travelers, the Hartfords, kind of the large insurance carriers. They're the ones providing the insurance. The agent is the one providing that conduit to you. And again, you're not paying the agent. They get paid by the carriers. You don't have to pay them to do this work for you. I recommend doing this because some people would just go on to a generic website and fill out a form and just buy a policy. I find that talking to an agent about these things, they may point out a few things, and there could be some nuance in the conversation that you don't get through just filling out a form online. But that'd just be my preference.
The next question is from Nolix, and he said, what if you have a hybrid company that has both products and services? Do you do a hybrid chart?
Yes, so that's a great question. And we do have this from time to time where so if you think about those examples, we talk about like, how do you earn revenue? How's your revenue model? And we said, is it, a cost per unit and a sales price per unit, or is it a, per dollar per hour kind of revenue model? It could be both. Absolutely. And this happens sometimes too, right? You can think about like I'm going to use a hair salon, right? They may charge you per hour or per haircut, but they also may sell product. So it's the same kind of concept. So you'd want to think about your revenue sources for both of those. How many haircuts am I going to do per week, and how much am I charging per haircut? And if I do a couple specialized services, how much am I charging for those? And then let's say I sell 20 bottles of this per month, and how much am I going to earn per that per month on a gross profit basis? So exact same concept. You just want to look at both of them together and then kind of add the two together to say I'm going to earn X amount of revenue for my styling services, whether it's haircuts, colors, or other things. Plus, I'm going to earn Y amount through my product services as well. And you can think about both of those revenues going together.
Yeah. And typically, Steve, I think a lot of companies are sort of primarily one, and then the other is supportive. And so I think Nolix wrote that the example he's thinking about is a storage company, right? So a storage company would be primarily service. You probably sell boxes and packing tape, things like that as well, but primarily service based. I think most companies are going to be focused on one or the other.
Yeah, that's a great way to look at it. It's a primary and then a secondary. And that's another way is you're thinking about, if you think about that 80/20 rule that I was talking about, if your primary business is renting storage units and you say, well, maybe I'll sell some boxes and some other packing materials on the side, spend most of your time thinking about how many storage units you're going to rent and for how much. That's where you should spend 80% of your time. And you think I'm going to earn an extra $500 a month selling boxes and packing supplies, just put that in your cash flow model, but spend most of your time on your primary source of revenue. That's a great point, Al.
And then the last question we have is just asking you to reiterate how everyone's going to get access to the PowerPoint slides and the documentation.
Yeah, so great question. So tomorrow you'll get an email from SCORE. It'll have a few things and it'll have a link to today's recording so you can go back and revisit anything we talked about today. It'll have a link to the PowerPoint presentation that I went through today, and it'll have a link to each of the two Excel documents. So you'll be able to click on the link and you'll be able to save it to your computer and then just kind of play around with it. And then the cash flow template is set up in such a way to try to create a bunch of formulas so that you can kind of play around with it. You're going to see some example numbers in there that you can kind of clear out, but I encourage people the rows and columns that are highlighted are formulas, so don't change those because they will help with all the kind of totals and subtotals as you go along the way. And if you start using that tool and you think, hey, I could kind of use another set of eyes or some help on this in a little more detail, or maybe you're not the most astute at using Excel, a SCORE mentor is the perfect kind of person who can help you with that. And with that in mind, why don't we, Kathleen, launch our second poll? That's a good segue. Just while we got a minute. And this is just a poll. We're going to ask if you're interested in a SCORE mentor. If you are, just please let us know by answering the second question, yes. And you'll get an email from me later today telling you how to do that. And if you're already working with a SCORE mentor, that's great. But if not, we can tell you how to do that. And you can sign up at score.org to do that as well.
So
Any other
Steve, I
questions?
wanted to bring up something that we didn't talk about during marketing because it's more applicable to this session, which is gross profit percentages. And you talked about that and how it's going to be different. And one of the things that I would encourage people to do is to research what the benchmark gross profit margin is for the type of industry that you're in. Because most of us probably are aware that gross profit margins of restaurants are very low, and grocery stores aren't that high either. But gross profit margins for, say, service-based businesses or software companies tends to be higher because you don't have as many variable costs that Steve was talking about. And so once you spend the money, now you can just sell more and it doesn't matter. So you want to make sure that you're not, when you're thinking about pricing too, that you're not pricing yourself to the point where your gross profit margin is significantly lower than your competition.
Right. No, that's a great point. And I forgot to add that in the spreadsheet here, but I just compared like in Sarah's two examples here. This one, her gross profit percentage is about 37%. And the way you calculate that is you take your gross profit per unit divided by your sales price. That's how you calculate gross profit percentage. And in the second example, her gross profit percentage is close to 50%. And that's because her sales price is higher and her cost of goods has changed. So yeah, if you want to think about that, your goal in whether it's a service business or a product business is you want that gross profit percentage or that net profit percentage. You want to get that up as high as possible. And you can do some research on what the standards are, as Kathleen said. So you brought up the great example, which is grocery stores. I think you mentioned maybe you mentioned restaurants, but grocery stores, if you look at some of the large grocery store chains, they have very thin profit margins. A lot of retailers have like 6% of profit margins. You think, God, how can they make money? It's because of volume. They're just pushing so much volume through those businesses that every time a sale goes through, if 5% is fine, they're making enough dollars of profit on that low profit percentage. So then when you look at a business like Apple, their profit percentage are like 60, 70% because it's a luxury, not a luxury item, but it's an item where people have the strong value proposition that Apple has. They can charge so much for a phone because people know they're going to get that high quality experience with it. And they're like, I'm willing to pay for it because it's going to save me so much in time and efficiency. I'm willing to pay for that. So Apple can afford to have those really high profit margins. There's no perfect answer. It's a lot of things triangulating together. The competition's price point, the other industry standard benchmarks, the value proposition you have, the uniqueness of your product, your own profitability goals. There's a lot of different things that can influence that. All right. Any other questions or anything else I missed that the two of you can think of?
Nope, no additional questions from anyone at the moment.
All right, great. Well, I want to thank everybody for joining today. Hope you learned something, and hopefully this helps you as you're managing your business financials. A few quick reminders. You can learn more about us at score.org, where you can sign up for mentoring services or check out other webinars that we have. Reminder to sign up for Monday's last class on time management and getting your priorities done. A huge piece of advice that Kathleen's going to give you, a lot of advice on how to actually run your business, in addition to some of the technical things we've been talking about in these first 4 classes. You'll get a link to register for that class as well in tomorrow's email, or you can do that on our website now. You can find all of our webinars on our YouTube channel at SCORE. Look for SCORE Greater Hartford, and you can find all the webinars that we have, and you can also subscribe to be notified for ones in the future. So thanks everybody for joining today, and I think we can go ahead and stop the recording, and we'll see everybody soon.